50-pound backpack on because of the decline in velocity. Now, Milton Friedman, who kind of invented this whole school of thought, said he believed that velocity was more or less constant. And in his lifetime, his productive lifetime, it was. From 1950 to 1980, velocity was constant at about 1.1. But over a longer time series, you can see that actually velocity is highly volatile. This is the stretch from 1950 to 1980. That's when Milton Friedman did all his work. And what economists assumed was, if you hold velocity constant, right, then all you have to do is dial up or dial down the money supply, and you'll get nominal GDP. And if you furthermore say that real GDP can only grow about 3%, because it's, what is this, 1% population plus 2% or so technological innovation, so it's population plus productivity. There's nothing else in GDP. So if you can only grow about 3 or 4%, dialing up the money supply more than that will increase inflation if you hold velocity constant. The problem is velocity is not constant. You can see it peaked in 1998. Prior peak was 1918. 10 years later, you had the stock market crash. 10 years after 1998, you had 2008. Now, velocity has continued to decline from this level. This chart's about a year old. But again, Bernanke's swimming into a very strong current because of the decline of velocity, and then the Chinese are out there throwing rocks at him because of the yuan peg. So you have some sympathy for the fact that you can't get inflation, assuming inflation is something you want. It has its own problems. So I said velocity is going down, so money supply has to go up. Where's the evidence of that? There's your money supply. Now, imagine you were a pilot trying to fly this flight path. You wouldn't make it. That's pretty steep. But Fed doesn't have this kind of aerodynamics to worry about. That's money is. By the way, this is before QE2. Sorry, no, this is before QE2. QE2 will take it off the charts. Remember Al Gore in Inconvenient Truth when he had the scissor lift to show how bad things could get? Well, you're going to need that to show where the money supply is going. It's on its way to $3 trillion. By the way, the capital of the Federal Reserve is $57 billion. So if you take the $3 trillion and just haircut it by 2%, the Fed is broke. The Fed's capital on a mark-to-market basis is probably negative. So we have a central bank of issue that itself is broke because they're not buying good assets. They bought $1.4 trillion of mortgages. How are they doing? They bought stuff from Bear Stearns. Then the old Fed used to buy 30-day Treasury bills. It's the safest investment in the world. The new Fed's buying CMBS, junk, mortgage-backed securities, stuff originated by Countrywide, and they're buying 7-year notes, which are good from a credit point of view, but they're highly volatile. Think about, Bernanke said he can deal with inflation by selling the bonds and taking the money out of the system. Yeah, that's true in theory, but what is the world where that's happening? The world where that's happening is the world where interest rates are going up. What happens to the price of a 7-year bond in a rising interest rate environment? Well, bond prices move inversely to interest rates. So the time when you want to do that is the time when the prices are going to come down. They're going to lose money in the unwind and go broke. So we're looking at the possibility of a bankrupt Fed. It's just, like I say, it's not math. It's not a political presentation. All right, so where is this all leading? This is a dynamic model of how the dollar will collapse, and it's pretty simple. So just make up numbers, 311 million people, it's a nice round number for a population in the United States. Of case 1, case 2. For any of you who are physicists, deal in fissile materials or other dynamic critical state systems, this will all seem like very familiar stuff. So T is a threshold. T is a level where that's my threshold. So when I see somebody act in a quantity greater than T, I act. So case 1, we're subcritical. So what happens is 1,000 people reject the dollar, right? So 1,000 people reject the dollar, but for the next group, sorry, did I do this right? Oh no, sorry, 500 people reject the dollar. And then at that point, I'm sorry, there's my premise. So, okay, assume 100 people repudiate the dollar. So this is what happens. 100 people reject the dollar. Well, when 100 people reject the dollar, the next 1,000 people had a threshold of 500. In other words, if 500 people reject the dollar, they would reject it also. Their critical threshold is 500. But what happened is, 100 people rejected the dollar. It wasn't 500. It fell below the critical threshold. So nothing else happened. That phenomena died out right at that level because that number is less than that number. Now, let's change it. And I'm only going to change two variables. I'm going to make the 500 100 over there, and I'm going to make the 10,000 1,000. But the bottom three are the same. Everything else in this system is the same. Now, 100 people reject the dollar. Well, what happens? Well, at 100, you've triggered the threshold for 1,000. So now 1,000 people reject the dollar. At that 1,000, you've triggered the threshold for 1,000,000. Now 1,000,000 people reject the dollar. Now the next threshold was 100,000. Well, we had 1,000,000, so we're over that. So now 10 million people reject the dollar. At 10 million, you've hit the next threshold, 100 million. The next threshold was 50. We crossed that with hundreds to 200 million people. In the aggregate, the entire population of the United States rejects the dollar. This is exactly like you're in a movie theater and 3 people get up and they run out. And you say, that's odd. But you sit there, like your threshold is higher than 3. You think it's odd, but you don't want to get up and run out yourself. But now you're sitting there, 10 people run out. You're like, something's up. They know something I don't know. The place is on fire. I don't know. I'm out of here. In other words, there's an example where at 3, you haven't hit my critical threshold, but at 10, you have. So it's exactly like everyone running out of a crowded theater. It's exactly what happens in a chain reaction. You know, a 35-pound block of uranium in a cube is pretty harmless. You'd have to eat it to get sick. But if you shape it into a softball in a barrel and put it in a tube and fire it together, you can blow up a city. Same uranium. It has to do with the array and how you start a chain reaction. This is how you start a chain reaction in the dollar. So one last thing. This is the maturity structure of national debt of major countries. So this is take the entire national debt, because we issue 30-day notes, 6-month notes, 1-year notes, all the way up to 30-year bonds. So take the weighted average of all that debt, and what is that number? Well, in the United States, it's about 4 years. Think of these as seconds. Imagine you have a hand grenade and you pull the pin, and the question is, how long will it take before that hand grenade explodes? Well, if you're England, you got 12 seconds. If you're the US, you got 4 seconds. We have almost the shortest maturity structure of any major country in the world. The reason for that is we used to spread it out. That number used to be close to 7, which is a much more comfortable number. But interest rates for shorter maturities are lower. So if I issue a 6-month bill, I pay about 20 basis points. But if I issue a 30-year bond, I have to pay about 3%. So you have almost 3 percentage points. So if I issue the shorter maturity, I pay less interest this year. That helps the deficit. But there's a price to pay, which is that interest rate saving in the short run. Think of it as a premium that you receive for selling insurance to the world. The U.S. is short volatility. So another way to think of it, just think of it as a fuse on a bomb. We have a very short fuse. So go back to the last slide of what the critical dynamic is and look at this slide. Realize we have a very short period of time. By the way, this doesn't mean we have to pay off the debt in 4 years. That's not what it means. What it means is that on average, we roll it over every 4 years. And so you're constantly going back to the market. So it wouldn't take much to get this going. And if it did get going, we'd have very small margin for error. So this is a major threat for the United States. So what do we got? In summary, debt cannot be repaid. Inflation is one answer. But I've suggested that the process of inflating is dynamically unstable. You could cross those thresholds that I just showed you, and the result in due time would be a collapse of the dollar. So this is the threat that we're facing, and it's cumulative and not going away. Now, I had a section in the outline on state capitalism, what I call China, Russia, and state capitalism. It's very well detailed in the outline. I'm actually going to cut back on my comments a little bit because I want to save time for a lot of other things we want to cover. But just kind of briefly, and again, there's a lot more detail in the outline. What we're seeing in Beijing in particular, but also somewhat in Russia, is what I call neo-mercantilism. Neo-mercantilism is a more technical term for state capitalism. It's actually not a new school of economics, if you will, or economic behavior. If you go back prior to the 18th century, or prior to the 19th century, in the 17th and 18th centuries, mercantilism was the predominant economic mode. And what it really says is that classical mercantilism says that wealth is in tangible things: land, gold, silver, other fine art. That was wealth. And the way you got wealth, you could create a little bit of it, but you didn't have very productive economies in those days. There was really the Industrial Revolution that led to a revolution in productivity. The way you got wealth through thousands of years of history was you stole it. You went and attacked somebody and took their stuff and left them destitute, and you got their stuff. And that's what wars were about. That's how people got rich. They attacked people, they invaded people, they blockaded people, they had pirates, you name it, but you just sort of took the other guy's wealth, and because you couldn't create that much of your own. But it was really, it took on a policy cast and involved export subsidies, import tariffs, exclusivity in trading relationships, trading blocks. So the British Commonwealth is a classic example of a trading bloc. Basically, the acquisition of wealth was predominantly, not exclusively, but predominantly a zero-sum game. And to paraphrase Clausewitz, trade was the continuation of war by other means. Now, beginning in the mid-19th century in England and becoming much more prevalent in the United States and globally in the 20th century was what's called the Washington Consensus. It's based on the idea of comparative advantage. And just to, for those of you who don't recall, again, Econ 101, imagine a very simple economy. There are only two people in the economy, Tom Brady and me. And there are only two things to do in this economy, play football or mow the lawn. Those are the only two things you get to do. So we can kind of stipulate that Tom Brady plays football better than I do, so we get that. But he probably mows the lawn better than I do too, because he's younger, he's more fit, he's an athlete. So in a mercantilist society, Tom Brady would play all the football and he'd mow his own lawn, and I'd be poor and starving to death. That's what a mercantilist economy looks like. But in an economy of free trade and comparative advantage, you say, well, he may mow the lawn better than I do, but that spread is kind of thin, whereas in football, he's way ahead of me. So it really makes sense for him to play football all the time and make more money and then pay me to mow his lawn, even though I don't do it as well as he does. That's still a better deal for him because he'll make more money playing football. Even after he pays me, he's better off. And I'm definitely better off because now I got a job mowing the lawn. So that's a case where even though you do everything better, you do some things way better. And if you concentrate on those and let the other guy do the things that where the gap is narrower, everybody's better off. That is a very strong intellectual foundation. It works, and that's comparative advantage, free trade. And this is what we call the Washington Consensus. And what does that require? It requires free trade area, low tariffs. I mean, you can have it in a suboptimal world, but to move towards optimality, the fewer barriers, the better. So get rid of capital controls, get rid of tariffs, freely convertible currencies, free flows of capital interest and dividends, very few, if any, restrictions on direct foreign investment, mobility of labor, reciprocity and non-discrimination and expansion of global companies, protection of intellectual property, protection of creditors, some kind of system of bankruptcy, reasonable antitrust laws, no protectionism, and general adherence to the rule of law. I realize I went through that quickly, but you get the sense it's a package of kind of advanced, reasonable, fair ideas that this was the engine really going back to the 1980s, 1990s, early part of the 21st century. This was the engine of globalization. And this was how wealth was maximized. Now, there is emerging, in contrast to that, what's called the Beijing Consensus. And I think it applies to Russia and some others as well. And the United States has assumed in policy that, you know what, give China a break. You know, it wasn't that long ago they were in the Cultural Revolution or the Great Leap Forward. Before that, they had, chaos for 100 years from the fall of the Ming Dynasty through the Communist Revolution in 1949. And they've come a long way. Let's give them credit for that. Let's not nitpick too much the places where they fall short because they're moving in the right direction. That was Washington's view of how to treat China. It's becoming more and more apparent that China is not conforming to that view. They do to a point, but they're not moving nearly as far in our direction as they are capable of doing, and they're beginning to show their true colors. They're beginning to show this neo-mercantilist bent. We're seeing a lot of examples. You also the imposition of quotas and bans on rare earth exports. China and Russia both have captive gold mining industries at this point. The way they're building up their gold reserves without having market impacts is they're actually capturing the input of their own mines at below market levels. large and growing state sector, you know, the players, gas